Hello and welcome. If you're retired or even just thinking about it, you are going to want to lean in for this. There are some really big changes coming down the pike for taxes and Social Security, and these new rules could have a huge impact on your wallet. So let's just dive right in. So let me start with a question. Do you feel ready for the next tax season? Because getting up to speed on the new rules we're about to cover could seriously change your financial picture. And I'm not talking about pocket change. We're talking about potentially thousands of dollars in savings. Okay, so what's all the buzz about? Well, the main event is a major new tax proposal. For our purposes, we're calling it the One Big Beautiful Bill Act. It's designed to bring tax relief to a lot of working Americans. And, most importantly for our chat today, it has some incredible new benefits for seniors. Now, this bill covers a lot of ground, things like new deductions for tips and for overtime pay, but we're going to cut right through the noise and zero in on the one piece that is going to be most impactful for you, that enhanced deduction for seniors. Let's dig into the good stuff. This new deduction is a real game changer, and it is so important to understand exactly how it works and, of course, how you can actually use it to your advantage. Let's break it down. All right, ready for the headline number? Here it is. This act rolls out a brand new deduction of $6,000 per person for seniors who qualify. I mean, think about that. That's a huge chunk of income you can now protect from taxes. And you know what? It gets even better for married couples. If you file jointly and both you and your spouse are eligible, that benefit doubles. We're talking a whopping $12,000 deduction. That could absolutely slash your tax bill. Okay, so of course there are some rules. Who gets this? Well, first, you've got to be 65 or older by the very end of the tax year. Simple enough. There's also an income limit based on your modified adjusted gross income, or MAGI. It needs to be under $75,000 for single filers or $150,000 if you're filing jointly. And here's some really great news. It doesn't matter if you itemize or take the standard deduction. You can still get it. Now, I really need to make this crystal clear because this is probably the most important part. This new $6,000 deduction does not replace anything. It's brand new, and it gets stacked right on top of the extra standard deduction that seniors already get. It's pure extra savings. So, this fantastic new deduction naturally brings up another huge question I hear all the time. What happens if you decide to go back to work or keep working while you're collecting Social Security? Well, that's where something called the earnings test comes into play. It's the million-dollar question, isn't it? Can you actually earn a paycheck without it messing with your benefits? Well, the short answer is yes, but, and it's a big but, there are limits you have to know about. Let's get into the nitty-gritty for 2026. Okay, so here's the deal. There are two different scenarios. First, if you're younger than your full retirement age for the whole year, your benefits get reduced by $1 for every $2 you earn over $24,480. But if 2026 is the year you reach your full retirement age, the rule is way more generous. They'll only reduce your benefits by $1 for every $3 you earn over $65,160, and that only applies to the months before your birthday. Once you hit that full retirement age, boom, the limit is gone. But just as important as what counts is what doesn't. The Social Security Administration only cares about your active earnings, so wages from a job or what you make from self-employment. All your other retirement income, your pension, annuities, investment earnings, capital gains, none of that counts toward the limit. That's a really key distinction to remember. All right, so we've got the earnings test figured out, but that just leads to the next big question, right? Even if you collect all your benefits, are you going to have to turn around and give a chunk of it to the IRS in taxes? Well, the answer to that question all hinges on a little formula the IRS uses called combined income. It sounds kind of official and complicated, but it's not so bad. Basically, they take your adjusted gross income, add in any non-taxable interest, and then they add half of your Social Security benefits to that. That final number is the magic number. So once you have that combined income number, here's how it plays out. If it's below $25,000 for an individual or $32,000 for a couple, congratulations! Your benefits are 100% tax-free. As your income goes up from there, a piece of your benefits, up to 85%, can become taxable. But here's where it all connects. That awesome new senior deduction we talked about can help push your income down, hopefully below these thresholds. It's fantastic news. So that's the whole story on the federal side. We've got that covered. But we're not quite done yet. Don't forget, there are 50 states out there, and some of them might want a piece of the action too. Now, the good news is most states do not tax Social Security benefits at all. But if you live in one of these 9 states, Colorado, Connecticut, Minnesota, Montana, New Mexico, Rhode Island, Utah, Vermont, or West Virginia, you might owe some state income tax. The rules are all over the place, so if you see your state on this list, you've got a little homework to do. You'll definitely want to check your local tax laws. Whew. Okay. I know that was a ton of information to absorb. So let's bring it all home and wrap this up by focusing on your next steps and some amazing resources that can help you sort through all of this. First things first, you do not have to figure this out by yourself. There are some incredible and best of all free programs out there just for you. VITA and TCE are sponsored by the IRS, and the AARP Foundation's Tax Aid program has thousands of spots open every tax season. These are trained volunteers who can help you get it all right. And here's something super simple, super practical you can do like right now. Go to ssa.gov and set up your My Social Security account. Seriously, it's the easiest way to get your benefit statements, check on your earnings record, basically to manage everything in one secure place. You know, when you really boil it all down, this is what it comes to. The tax system, Social Security, yeah, they're complex, and the rules are always changing. But being informed, being proactive, that right there is your best tool for making sure you keep as much of your hard-earned money as you possibly can. So, I'll leave you with a question to chew on. Knowing there's a potential $12,000 extra deduction out there and having a clearer picture of the earnings rules, how might that change the way you plan your work, your savings, and your spending in retirement? Something to think about. Thanks so much for joining me.